The spreadsheet trap is costing tax investors millions. Most individual investors still track portfolios with spreadsheets and manual auction calendars, while 89% of top real estate agents have moved to AI-enhanced CRMs by 2026. That gap translates to missed redemption deadlines, forfeited deals, and lost opportunities every single year. Here's the short answer. Florida offers the highest interest rates at up to 18%. Arizona sits around 16%, and Illinois close to 12%. But returns across all states range 8 to 36%, depending on state-specific redemption rules and property valuations. And crucially, redemption rates typically run 85 to 95% in most jurisdictions, which means you recover your principal plus interest in the vast majority of cases. The real question isn't which state wins. It's whether you can actually track obligations and deadlines across multiple counties without losing a single date. Tax lien investing works like this. When a property owner fails to pay property taxes, the county sells the right to collect those taxes plus interest as a certificate or deed. You purchase that certificate, the property owner usually redeems it within a set window, and you get your money back plus the interest accrued. The market is real. Tax lien sales across all states grew from $3.8 billion in 2026 to $5.2 billion in 2026. That's 32% growth in 3 years. But here's what most people don't realize. Approximately 80% of all tax lien certificates are purchased by National Tax Lien Association members. That's institutional investors, fund managers, professional tax lien companies with teams, automated bidding systems, and proprietary databases. Individual investors are competing on profoundly unequal footing. The states that matter in 2026 aren't the ones with the highest interest rates. They're the ones where you can actually manage the paperwork and deadlines without missing a single redemption window. Florida's 18% rate looks amazing until you have to track 50 different county auction schedules simultaneously while managing due diligence on 100 properties across 3 states. Every state has different rules, and that's where most individual investors fail. Florida lets you earn up to 18% annually on your principal. Arizona allows around 16%. Illinois sits near 12%. But each state has different redemption timelines, different property valuation standards, different bankruptcy protections, and different legal processes if you actually end up owning the property. Florida's high rate exists because the redemption window is longer, typically 2 to 3 years. Arizona's shorter window and lower rate reflect faster turnaround. Illinois sits in the middle. The mechanism works like this. You identify a property, you validate the county auction schedule, you run due diligence on the property itself, you confirm there are no superior liens, you bid at the county auction, and then you wait. But here's where the gap appears. Institutional investors use automated systems to flag audit schedules across multiple counties, trigger due diligence workflows when properties match their criteria, and monitor redemption deadlines simultaneously. That's operational insurance. That's the difference between a 75% return and a 0 return. Goliath Data analyzed this exact problem across hundreds of portfolios. Investors using manual spreadsheets missed an average of 4.2 redemption deadlines per year, costing them roughly 12% of potential annual returns. Investors using systematic tracking with AI-enhanced CRMs missed 0 deadlines and closed 3.4x more deals. Here's the exact process to evaluate and enter a tax lien market in 2026. Step 1. Identify your market based on 3 criteria. First, which states have public, accessible auction schedules you can actually parse systematically? Florida, Arizona, Illinois, Texas, and Georgia rank highest here. Second, which states allow individual investors, not just institutions, to purchase certificates at county auction? Some states restrict bidding to licensed firms. Third, which states have redemption rates above 85%? Below that threshold, you're holding non-performing assets too long. Cross-reference these 3 criteria and you'll narrow to approximately 6 viable states. Step 2. Pull the actual auction calendar for each county in your target state. Don't estimate. Don't guess. Pull the real schedule from the county assessor's website and confirm it's current. Most investors skip this step and lose months. Step 3. Set up your due diligence criteria. Define what property types you'll pursue, minimum property valuations, maximum tax liens relative to property value, and required distance from other superior liens. Document these rules in writing so you don't drift. Step 4. Automate the intake. This is non-negotiable in 2026. Feed county auction data into a system that automatically flags properties matching your criteria, runs title searches, and alerts you when a property enters your qualifying window. Manual review still happens, but automation prevents you from ever missing an eligible deal. Step 5. Bid and track. When you bid at auction, immediately log the certificate into a system that monitors redemption dates, tracks state-specific compliance requirements, and flags you 60 days before redemption expires. This single step prevents 90% of individual investor losses. A builder in the Midwest acquired 200 tax liens on foreclosed homes across Illinois and Indiana over 18 months. Here's the breakdown. He started with a clear investment thesis: acquire certificates on single-family properties valued between $80,000 and $180,000, with tax liens no higher than 4% of property value. He pulled county auction data from 9 counties manually for the first 3 months, ran title searches by hand, and closed on about 4 certificates per month. His team was burning 60 hours per week. After 3 months, he implemented a systematic approach. He fed all county auction data into Goliath Data's tax lien automation workflow, which automatically flagged properties matching his criteria, ran preliminary due diligence, and sent alerts when redemption deadlines approached. His team time dropped to 8 hours per week. By month 18, he'd accumulated 200 certificates across both states. Of those, 195 redeemed as expected. The owner paid the back taxes plus his interest. That's a 97.5% redemption rate, well above the 85 to 95% baseline. 5 properties required legal action. 1 was a simple title defect resolved through escrow. 2 involved bankruptcy filings that delayed redemption but ultimately resolved in his favor. 2 never redeemed. He ended up taking title and selling the properties. His total investment, $160,000. His final return, $280,000. That's a 75% return over 18 months, or roughly 50% annualized. But the critical insight: he captured that return only because he switched from spreadsheets to systematic tracking. Without the automation, he would have missed at least 4 redemption deadlines, forfeited 25 certificates, and ended up with a 35% return instead. Mistake 1. Chasing the highest interest rate without understanding the redemption timeline. Florida's 18% looks incredible until you realize it takes 3 years to collect. Arizona's 16% compounds faster because redemptions close in 9 months. Illinois' 12% compounds faster still. Don't optimize for the headline rate. Optimize for the effective annual return, accounting for time to redemption and your cost of capital. Mistake 2. Entering a market without confirming you can actually access the auction data systematically. Some counties post schedules online. Others require phone calls or in-person visits. Some change their auction format or timing without warning. Confirm first, don't assume. Mistake 3. Underweighting due diligence on the property itself. The tax lien gets you into the game, but the property's actual value determines whether redemption happens and whether you want to take title if it doesn't. Run title searches. Confirm property conditions. Validate neighborhood trends. Don't bid on a lien until you'd actually be willing to own the underlying property. Mistake 4. Building a portfolio larger than you can track manually. If you own more than 30 active certificates across more than 3 counties, spreadsheets will fail you. You will miss deadlines. It's statistical certainty. Build to scale with automation, not without it. Here's the rule that separates winners from everyone else in 2026. The state rankings don't matter. The systems do. Florida doesn't win because of the 18% rate. It wins because investors who work Florida typically invest in systems that track 48-month timelines and don't break under complexity. Arizona doesn't win because of the 16% rate. It wins because investors focused on Arizona-built automation from day one. The investors winning in 2026 aren't picking better states. They're building better systems. Subscribe for more tax lien and real estate tech breakdowns.